I am so fortunate to have a someone that I admire. He's a colleague. In the past, I guess we'd say we were competitors, but no, you never really competitors because all even our competitors, we always work together and help each other out. At least those of us that have long-term view of the industry. But Ron McMahon, thank you for joining.
No problem. Nice to see you, Bill.
So I want you to give my audience the kind of your 20-year background. Well, it's maybe more than that, even though I still consider you a young guy. Um, you have been through multiple credit cycles in real estate and most recently founded and ran one of the premier private investment firms in non-performing, sub-performing residential real estate mortgage loans. And I just to give everyone sort of your history that don't know how amazing you are. Tell us who Ron McMahon is.
Uh, Thanks. So I have been managed investment funds and made principal investments in distressed real estate since the late 90s. I was working for a venture capital fund in the 90s that provided financing to park operators for manufactured housing. And that investment kind of blew up on us in the early 2000s when the securitization market figured out that first payment default was more common than a common payment in that sector. And from there, I founded a mortgage brokerage firm, and we had a different approach than most people at that point. We were providing hard money second loans to individual homeowners. They were being presented with opportunities. I'll say it's an opportunity. It was really kind of a prison sentence, which turned into the first crisis. But they were being presented by 2 and 3 and 5 year ARMs with prepayment penalties longer than the fixed rate portion of the loan, low double-digit interest rates, and they were horrible loans. And one of the problems that's been endemic in the mortgage industry is that a lot of times lenders make a lot of money at the expense of borrowers. And certainly from about 2002 to about 2007, that was the case. So what we did, as opposed to broker subprime loans, was we provided hard money seconds to individual homeowners, generally speaking, from 50,000, maybe $100,000. We didn't give the money to the homeowner. We paid their bills with it. A lot of times we brought their mortgage current, we paid off credit cards, and then we worked with them for a period of anywhere from 3 to 6 months, basically doing informal credit counseling and helping them improve their credit score to the point where they could then transition from the loan that they were currently in our second to a 30-year fixed rate mortgage with Fannie or Freddie at a level 2 or level 3 approval. And the difference for them at that point was life changing because they could get a rate anywhere between 6 and 7.5% versus 12 to 13, 14% on subprime loans. They were 30-year fixed rate mortgages. There were no prepayment penalties associated with those loans. So it was a win-win because we were one of the few companies offering that solution. We were making huge fees. And also, it kind of prepared me for 2007 when I met Guy Johnson, the founder of Johnson Capital and the former vice chairman of Walker Dunlop. And Guy introduced me to the folks at Fortress Investments. And we started managing a non-performing mortgage fund, primarily focused on residential properties. So we also did small balance commercial and primarily mixed use and multifamily. And that's what I did from 2007 to 2023, the end of 2023. The various funds that I managed purchased over 20,000 units or doors, however you want to characterize it. We raised around $6 billion of debt and equity. We bought loans from Maine to Southern California, geographically concentrated generally in the Florida area in the Southeast United States. Probably about 40% of the properties that we purchased were in that area. We had a great run. I had great institutional investment partners, Double Line, Beach Point, Fortress, Citibank, Goldman Sachs. I've dealt with just about every institutional lender and principal investment fund in distressed mortgages over the last 20 or so years. The last 6 or 7 years, our returns to investors net of our fees was over 25%. So we had a great track record. I had great partners. Some of my employees now run, former employees that I hired now run AMEP. Some of them now work with me at my new company foundation. So it's been great. It's been great to help people. Of the occupied single family properties that we purchased, about 75% of the families were able to maintain their home, which is almost double of the industry average for Fannie Mae and HUD defaulted mortgages. So we were quite happy about that. We learned a lot. We learned a lot about litigation. We saw a lot of fraud, both on the part of homeowners, on property investors, and unfortunately on lenders as well.
Yeah.
So and it really kind of in 2023. Housing prices had risen probably 200% since 2014 or 2015. Everybody had equity. Liquidity in the secondary market for the resi space was drying up, and I really wanted to refocus into small balance commercial, which is what I'm doing now. So I left my company, and I'm now the majority shareholder and CEO of Foundation Specialty Finance.
Which we're going to get into, and so what the future is. But I want to come back on some and highlight some of the points. You are a legend in the industry. I say I've said it to you before. I want to be you someday. And all of the folks that you've done business with, and everyone that I've known has always been has said nothing but positive about you. What I love is the keying in on, even in those days pre-GFC when you were on the origination side, even in those times where you recognize that, hey, the product that the pit that we were swimming in was full of mud, and we're going to obviously have to sling some mud, but we're going to follow through on the promise of helping people and getting them the back end knowledge, the back end support to actually get out of these loans that we know we're going to make some money on in the short term. But other lenders are just leaving those borrowers out to dry. And I really acknowledge you for your commitment to people. And, I think that's also why you and I are so attracted to each other, because our mission, sidelined to you as a little small fry, was when I got into buying these loans post GFC, how do we keep people in their homes? And we've talked about this. The best trade was paying, 30 cents of UPB, 60 cents of, 50 cents of property value, getting a borrower to give you 6-month trial, 3-month trial, just prove they can pay at the current property value. I've forgiven hundreds of thousands of dollars on thousands of loans. We were able to keep people in their homes because we weren't paying for that debt anyways. If a borrower could prove they could stay in the home and make the payment at the new real estate value, we could put them right back in an equity position, and it's a huge win-win for us. I mean, that was, and that's, I think that you, and I would like to hope that we, played a role together in really changing the approach to distress. Like, you can actually make positive out of distress. Even if you're the borrower who is having to walk away, the ability to walk away with dignity, with either we're waiving a deficiency, we're helping them with cash for keys, that there's not that just the freedom that a distressed borrower gets from having something complete. And, I think we've really changed the industry that way.
Well, first of all, thank you very much for saying that. I don't think of myself that way, but appreciate you saying that. So two things. I fundamentally believe that in any financial transaction, if both parties prevail and win, that it's better for both parties. Taking a binary approach to any financial transaction where I win and you lose, I think just results in acrimony. It ends up with one party wanting to, get revenge, whatever consequence after that type of a transaction there may be. I don't think it works out for either party. You can maybe make more money on one trade, but then you go and do the next trade, and someone's going to try to take advantage of you. So that's the first thing that's wrong about it. The second thing is that uh, you know, especially residential homeowners, when you're living in a house that's say you have a loan of $150,000 and your house is worth $100,000, and these are obviously numbers that have no reflection in reality today. But let's say that you have 40 or 50,000 or 40 or 50% negative equity in your loan. You don't really live in a home. You live in a debtor's prison. And so many people that I worked with, and because I was always the head of portfolio management for our company as well as the CEO, I talked to a lot of borrowers, and these are people who a husband and wife hadn't spoken for 6 months because the husband wasn't able to pay the mortgage. The kids were having a hard time. They were hiding from service, people trying to serve them with complaints. It's just a horrible way to live. And as you said, a lot of times the best solution for them is helping them relocate to a more financially accommodating situation, and getting them to understand that you're not going to kick them out of the house and leave them homeless. You're going to give them enough money to go pay a few months rent. In lots of cases, we helped homeowners, we pay their first month's rent or pay the security deposit. We'd give the new landlord or new homeowner, a positive recommendation on the person. So that could really, make a difference in helping to relocate people. Regarding your comment about modifications, when you are an originator of a loan and you've originated a loan for $150,000 and the guy's collateral is now worth $100,000, it's a lot different uh, decision to make to modify that loan, forgive that equity, and give the homeowner another chance. If you simply have to sell that loan and a guy like me comes and buys that loan for 65 or $75,000, I'm all looking at upside. So I totally understand the problem that's inherent in that situation where institutional originators or any originator taking those types of losses are horrible. And what you'd rather do is extend and pretend and hope that your collateral recovers its value, which is what we see today in the commercial industry. But people were extending and pretending a lot in the old days, 10, 15 years ago, in the resi space, where there's still a ton of negative equity. And oftentimes we would give more mods to homeowners who would never qualify for it, but we'd say, look, we're going to forgive $40,000 after you make 6 months of consecutive payments. Or if you haven't made your mortgage payment for 2 years, you're going to sign a deed in lieu of foreclosure, and our lawyer's going to hold it. And if you redefault in the next 12 months without curing that default, we're going to simply record the deed. So there's all kinds of unique ways that you can structure transactions as an investor
Right.
that a lender is not able to do.
Exactly. Like you said, it's all upside when we're sitting on our side of the equation and where our basis is way below
Yeah.
a situation where we're having to take individual losses, which is why you ultimately see these, like you said, a lot of extending and pretending, and you build up and a build up and a build up. And eventually the lender goes down, or the bank has to sell the whole pool at a major loss, or get FDIC stepping on their doorstep. That actually brings us into the state of today's real estate market. Let's get into it, because no time like the better to really. I mean, I think there's some exciting things going on. I think that there's about a good portion of the world and industry that maybe has their head either in the sand or just dazed and confused about what may be on the horizon. You mentioned commercial real estate. The general consensus in residential is that in the mortgage world, even though there may be stress coming in resi, there's still equity in general. But talk about the current state of the real estate market, and I'm sure you're going to want to talk about commercial first and what kind of excites you about what's going on, or what interests you, or what is your thinking?
Well, the analogy that I use is that in 2007 and 2008, the average borrower was significantly over leveraged and under collateralized. And what that means is they had borrowed way more money than their home was worth. Today, in the small balance, what I call the small balance commercial market sector, which is generally manufactured or multifamily is worth less than 10 million, 2 to 4 non-owner occupied, small retail shops, things like that. It's the exact opposite. Those loans are substantially over leveraged and significantly under collateralized. My firm has been working on a 250 million approximate portfolio of primarily non-performing loans that we were awarded a mandate on earlier this year from a private equity firm. And the average LTV on those loans that were all of the loans other than those loans that were performing, which was only about 25% of the population. The average LTV was about 130 to 135%
Wow.
of the collateral value. So you have an exactly the opposite situation. Now, interestingly enough, it's the same opportunity bill that you and I had in 2007 through 2010. By going in and restructuring that loan to the benefit of both the existing lender or the investor and the homeowner, the investor, whatever it may be, you all parties can benefit. And what's interesting for your audience to know is that 1 out of every 9 transactions for 1 to 4 unit properties is a non-owner transaction. So in other words, a rental property of some sort. Who owns those rental properties? 91% of those rental properties are owned by single individuals or single member LLCs, just normal guys like you and me. 91%. You hear a lot about, Wall Street taking over rental and all that. It's BS. It's basically, media hysteria. Wall Street's not taking over the rental industry. It's still 91% owned by single individuals. Interestingly enough, on small balance commercial properties, those same individuals own 68% of those properties. So it's the same guys. They have the same problems as the homeowner had in 2007, 2008. They don't have financial reserves. They don't have sophistication. They can't walk away. They can't walk away from $100 million office building in Akron, Ohio, like maybe Blackstone or Goldman or one of those large firms can. I mean, they have maybe 1 or 2 apartment buildings, and if they have to walk away, what did you just do? You ruined their life financially because people who invest in small balance commercial or non-owner occupied single family in the United States use those as their retirement. When they retire, they use the rental income or the lease income as passive income that they generate, much like a person that works in a automobile factory or a teacher or a police officer or fireman has their pension. These entrepreneurs who are, not hugely wealthy people, their pension is the form of real estate collateral that they've invested in. And now that collateral that they own is highly over leveraged and significantly under collateralized. So what are you going to do to resolve that problem for him? You need to be his partner. You need to help him keep the investment. You need to go to the bank and he owes, and here's another easy mathematical scenario to look at. A single investor bought an apartment building 3 years ago. Again, to keep the math easy, $150,000. Today, that apartment building is worth $100,000. The loan is $100,000. What are you going to do? Well, you approach the bank as an investor, or you approach the owner of the portfolio of loans and you say, hey, I'll give you 90 cents for that loan. Now, the bank or the investor that owns the loan can absorb that loss. Now you have a 90-cent cost basis in that property. How are you going to finance that? Well, you can give them a loan for $75,000. You can make a preferred equity investment for another $15,000, and you can require the sponsor or the owner to take a first loss position for $10,000. You've now done a structured refinance of complicated debt, just like you hear, lawyers on Wall Street go and restructure debt for billions of dollars. You've just now restructured this guy's debt as well. And that apartment building is at the bottom. Where's it going to go? 3 years from now, as rates normalize, as inflation continues to decline, that apartment building again is not, it maybe won't be worth $150,000, but it'll be worth $130,000. So you've just created the same economic cycle for the distressed investor in small balance commercial that you had previously in residential.
That's phenomenal. And that's really what you see the next couple years.
Oh, yeah.
Yeah.
Yeah,
And what's also interesting, are the banks doing this themselves internally? Do they have the capability, or do you think this is all going to have to flush out to guys like you and I?
Well, there is a huge number of these types of properties and larger commercial properties either maturing or already defaulted. Over the next 3 years, there's over $2 trillion of debt that is going to mature, which means it's due. You have to pay it, or it's already defaulted. I just wrote a short note on our blog, on our website. I just wrote, double defaults, which means a borrower defaulted on a loan. Then you gave him a mod. Now he's already defaulted on that mod because that extension has come due. A double defaulter, that's up 24% year over year in October, or excuse me, in September. So the way I characterized it is a tsunami, and there is a debt tsunami coming on shore. If you live at the beach like I do, the first stage is you see it way out there. It's coming. The second stage is water starts to wash up onto the beach, and that's called inundation. And then the third stage is, you get hit. Well, what's going to hit us in the commercial sector is called the maturity wall, which means banks aren't going to have capital to lend because it's all tied up in extend and pretend. There's going to be a lot of double defaults, and there's going to be a huge opportunity for investors, for individual investors in funds that are managed by people like me and you.
It's interesting because, there's right when you come to these cycles and these market turns, there is always there's even a growing kind of willingness to throw one's head in the sand and just get on board with the hysteria. I was on my way back from Greece and listening to a book on tape called Bubble in the Sun. And it was the story of the 1920s, basically 1924 to 1926, when, there was massive movement of people from the Northeast to Florida. Sounds familiar, doesn't it? A 2-year period of huge speculation, millions of dollars, billions by today's standard, that was being pulled out of Northeast banks and moved down and bought on speculative land deals and just money thrown. And eventually that ran to a resounding halt. There was huge fraud and con men, and the word, the man Ponzi became very popular. That he was alive during those days. He even took part in it. And there's even a case to be made that was one of that subsequent bust in real estate in Florida that then happened in the late 20s led to, or was a major factor in, the Great Depression. And no one saw it coming. Even bankers were buying and buying and flipping pieces of land, swampland in Tampa. But a lot of people got held, holding the bag. Now, I love that you're keying in on this low balance commercial, and I think you're right. I think that Wall Street is focused on bigger deals. It's not necessarily as glamorous to deal with moms and pops, but that is where the stress is. So what do you say though? Just going back to these folks that still might have their head in the sand. I mean, I was just listening to a leading expert economist that, doesn't see things coming, and they're cynical. They say, well, everyone thought there was going to be distress last year, and there was no distress last year. I'm a believer that it's not an if, it's just a when, and maybe it's hard to predict how much, all these trillions of printed money really, how long it took for the system to wear out. What do you say to the people that are still kind of stuck in, that there isn't going to be a major stress in commercial?
They're wrong. I don't. There already is major stress in commercial, and professionals in the financial industry are paid to have opinions, and sometimes contrary opinions make them more money. They get on TV more often, whatever the situation may be. There's, facts don't lie. You can deny reality as long as you want, but simple fact of the matter is that there's a huge number of these loans maturing in the next few years, and there's simply not enough available capital at the banks free to lend to those people. Also, it's quite a different ballgame for the commercial industry right now. In the resi space, I would say that, I probably have done more foreclosures than any individual in the United States. That's because I was in charge of our litigation and portfolio management. So I have a lot of experience in foreclosures, and I know people that work in the commercial investment market sector that have never experienced a foreclosure in a 10 or 15-year career. And I don't think that they recognize the warning signs, nor do I think that they understand the severity of what happens when those things occur. I will tell you that this portfolio that we're working on right now, I've never seen a 75% defaulted or delinquent or maturing in 90 days portfolio before. But I will tell you something that is analogous again to the residential market. B of A and Wells Fargo and people like that created a lot of defaults. Who created more? Subprime lenders that were non-bank lenders.
Right.
Were driven solely by profit motivation, did not have the same capital requirements, and were avaricious in their lending. Now, what has happened in the commercial space in the last 5 years? The growth of private bank lending. Now, I don't want to ascribe nefarious motives to my colleagues in the industry because we lend money as well as invest capital. But I will tell you, when you don't have capital constraints, when you don't have a third-party regulator constantly reviewing your balance sheet, constantly reviewing your portfolio performance, it lends itself to scenarios where people will take chances on loans that they normally wouldn't. And I just think the private lending sector is really going to drive a lot of the defaults that we'll see in the commercial space, especially in commercial bridge lending.
Very interesting. And do you think, like, for instance, when you look at that portfolio that you're discussing, and you're looking at the origination files, with your years of experience, can you pick out right off the bat that there was problems with the originations, or do you think that it was just from the perspective of some 30-something kid that just didn't understand the fundamentals of real estate?
Well, we did a very intensive case study at the halfway point of the project. It's available on our website. I mean, I don't want to plug myself, but
yeah, plug away.
www.specialty or foundationspecialtyfinance.com, just like it's spelled. And you can go to our blog and our resource center, and we have multiple case studies, and you can judge for yourself. But I think it was a combination of borrower fraud, poor underwriting, poor timing. Lots of things came together in a conflagration of a fire. And the fire has started burning, or the tsunami's come ashore, whatever analogy or
yes.
you want to use.
I'm right in the storm, so you know me. I love the tsunami analogy.
Yeah,
And that was just one small lender in a blip of a huge world of private debt. Like you said, the amount of private equity that has chased these non-bank lending situations has increased. It will continue. There's some that have already got their hands caught in the cookie jar. Some banks are probably wrapped up in that as well. And I think it's pretty clear what your prediction is in that regard. How
yeah.
about a key piece of advice or insight, for someone coming from now that they know what our context is for the next year or two? What would be, what's your kind of key takeaway, or any like piece of advice for someone that's says, well, okay, this is all great, fine and dandy. I'm a regular person. What should I do about it?
Well, I mean, there's lots of opportunities to invest in distressed funds right now.
Yeah.
So that's one opportunity. At the same time, for someone that's managing a fund, I think you should look for them to articulate a collaborative approach to distressed investment. What that means is everybody's got to win. The guy holding the note that's going to take a haircut, he's got to walk away. You don't have to take advantage of him.
Right.
Sponsor that's in the property, you have to help him keep the property and maintain his future, his pension. I mean, just think if we went around to all the firemen and took their pensions. But what if I said, okay, firemen, you have to work 2 more years, and that gives the system enough money to pay your pension in full? What would they do? They'd work the 2 years. So again, what I'm talking about is a collaborative approach to a really bad situation where people exacerbate the failure and exacerbate the harm on the various people, on various parties, is where they try to take advantage of people. So, if you have somebody telling you that they're going to return 50% in the debt in a distressed debt fund, say, no, you're not. Go talk to somebody else.
Yeah. Well, yeah. Never wanted to be a
Yeah.
vulture. I mean, that's exactly right.
Yeah.
If they're getting that kind of returns, then there's something wrong there.
Yep.
And that's right. There is a whole slew of workouts that will need to happen.
Yep.
And it's opportunity. It's really great stuff.